Okay, so today we had a question about resilience. Essentially, resilience is a forward-looking indicator that looks at the arbitrage between an index and the stocks inside of it. Now, the way that it works is a very simple process, is that anytime you have a stock that opens or closes on one day to the next, like a Wednesday and a Thursday, and say that we gap down from the close to the open from here to here, there's a huge share imbalance of sellers and buyers. And so that midpoint is relatively liquid, the middle of the two, right? Where buyers and sellers can meet each other. What we call that midpoint is a half gap, and it's demonstrated with the white line on your screen and an HG for half gap. When any stock raises price, the goal of the market maker is to find sellers. When any stock lowers price, the market maker's goal is to find buyers. But if I told you that buyers were here and sellers were there, then at any time you have the half gap and market starts to move and raise price, the dealers are looking for that burst of sellers, which will be here at the close. And when you're below half gap, the dealers are looking for that burst of buyers, which is here at the open. And it's the other way around if you gapped up. But the idea is if you look at any chart, right, any volume chart, if you look at the day-to-day activity, right, of any stock, you will see a U-shaped volume profile like a fish hook every single day. The most amount of buying and selling takes place at the open and close of the day on any stock. So the maximum amount of what we call buffering or order flow buffering, which is like sellers to find buyers or buyers to find sellers, take place at the closing and opening prints. So open and close prices on other side of a gap are very, 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 very high levels of buyers and sellers. It take a long time to break around. That whenever you are gapping down to here, that anytime you're at the half gap and they need to find sellers, there is a massive amount of sellers at yesterday's close and a pretty decent amount of buyers at today's open. So at half gap, what you'll notice is that anytime you're pivoting above the half gap, the next step is to connect with yesterday's close price in a gap down situation. So say that a random stock like Apple has moved from here to here. Our algorithm will know that Apple needs to do this. Anytime it's above half gap, Apple wants to connect with this price because that's where the sellers are. Apple has an actual move. Our algorithm will understand that there's an implied move that it needs to take. So our algorithm will say, okay, Apple has moved here, but it kind of needs to move there too, and it hasn't done it yet. So what resilience is equal to the market cap weighted sum of all implied moves of all stocks that need to fill. So an example is if Apple has moved up a little bit and therefore SPY has moved up a little bit, our algorithm will go, ooh, but Apple needs to move up a little bit more, and therefore SPY is undervalued for that potential move, and therefore SPY needs a little bit more oomph to it, so SPY will likely raise. Aha, right? It's going to aha moment. So when you sum up and weigh by market cap all of these implied moves, then you get the actual purest arbitrage of balancing the imbalance from open to close of the previous day of the market makers themselves undervaluing or overvaluing the SPY itself. That is a very fancy term by saying it is a gap fill predictor at the SPY's own half gap. Does the SPY pivot higher to find its gap fill or pivot lower to find its own gap fill? So at half gap, resilience is the tiebreaker at the SPY's half gap. So if we touch it and resilience is less than 0, then it's resistance. If we touch it and resilience goes positive, then it's support. And if we get here and resilience is positive, it means that the stocks are now implied move positive. Therefore, the SPY will need to get ahead of that, and some arbitrage mechanism or some trader will long the SPY, or the market maker will raise the SPY to get ahead of that desire of people needing to find sellers for SPY. So it's the first kind of live ticking indicator for the index. If you look at the advance and declines and the ticks and the trends and all of those type of things, they're only looking at what is and how it's ticking. This is the rate of the move that hasn't happened yet. So in every instance of resilience, it is a forward-looking thing and a leading indicator and not a lagging indicator. From this moment in time, right here, resilience was negative. Okay. So SPY is going to hover at best on its opening print because we got down. In a trading sense, when res is less than 0, you can just imagine that the algorithm is going to draw an arrow like that. If res is greater than 0, the algorithm is going to draw an arrow like that. If it's less than 0, draw an arrow like that. Greater than 0, draw an arrow like that. So it's showing from half gap, do we actually fill the gap or don't fill the gap? So in the easiest and simplest form is that the combination of the two resiliences, because they're color-coded for a reason, it's the tiebreaker at each level. So when you get to here, then you look at resilience. Oh, it's negative. Okay, that's resistance. If somehow we crash to here and it's hovering around, but yellow is still positive, then this is the same effect of the net sum of gamma squeezes on all stocks weighted by market cap. And therefore, we can guess, is SPY going to break its own hedge pressure or not? Based on what the stocks are. Oh, there's enough market cap holding hedge pressure. Okay, good. Then we'll hold. Pretty cool, right? Pretend that SPY opened here or closed there and opened here. If resilience is negative, anytime you're here, it wants to lower to look for those buyers right there and fill the gap. If resilience is positive, it wants to raise price to look for sellers there to fill the gap. The yellow number is when you get to here, it's the aggregate. It's a similar mechanism. It is a similar aggregate type mechanism. There's a little bit more math to it because half gap pivots to fill the gap. We know where it goes to. So there's an actual implied move. When you break through hedge pressure, there's a whole different mechanic down here, and we can't tell you what that does. Unfortunately, that's proprietary. But the way that yellow works is a similar mechanism, is a market cap weighted aggregate. Yes. So in a nutshell, as you're understanding, think of it like you just did. It is when you get to here, it's going to ask you how many stocks are we certain, or how much market cap in the S&P is holding its own hedge pressure versus how much is breaking its hedge pressure. Remember, these gamma squeezes have different mechanics to them. And so in the way of deciding it is that when you get to 410 on SPY, is there enough market cap gamma positive to hold the SPY there?